Hey guys, what's going on? My name is Hamish Hodder and we are back with another video. In today's video, I'm going to be answering a question that I've been seeing a lot recently. I saw this question a couple of times from you guys and I thought I'd better address it because it is quite an interesting question as well. And that question is, how do I deal with currency fluctuations between the US and Australian dollars when investing in the US market? Interestingly enough, in the past 12 months, my portfolio has gained 6.5% just from currency fluctuations, just from holding US dollars against Australian dollars. So I thought in this video, I would share with you my strategy for approaching sort of the conversion between Australian and US dollars and how I deal with that currency fluctuations when investing in the US markets. So before we get into talking about my strategy for dealing with currency fluctuations, let's talk about what currency fluctuations are. So for those who don't know what I mean when we're talking about the exchange rate between the Australian and US dollars, I'm going to show you an example of how the difference between the exchange rate when you're buying a stock between the US and Australian dollars and when you're selling a stock can drastically impact the return that you make on that stock. All right, so let's start off by assuming that you have 1,000 Australian dollars that you want to invest in Apple stock. Now, of course, to buy Apple stock, you need US dollars. So that means that you're going to first need to convert that 1,000 Australian dollars into US dollars. And let's say that when you do that, you get 750 US dollars. So the exchange rate that you've had from Australian dollars to US dollars is 0.75. So in other words, for every 1 Australian dollar that you have, you can buy 75 US cents. So your 1,000 Australian dollars converts into 750 US dollars. And just to make this example easy, let's just assume that Apple stock is trading at exactly $50 per share. So with your $750, you buy 15 shares of Apple stock at $50 per share. Then let's say that sometime in the future, Apple stock rises from $50 per share up to $100 per share. So you've made a 100% gain and you decide to sell it. So you sell your 15 shares for $100 each and you get $1,500 or 1,500 US dollars back from your initial $750 you invested. So as I just said, in terms of US dollars, you've made 100% gain. You turned 750 US dollars into 1,500 US dollars. But of course, that's not the end of the story. You have to convert that $1,500 back into Australian dollars. However, when you go to convert back, the exchange rate between the Australian and US dollars is now 0.8 instead of 0.75. So when you convert that 1,500 US dollars back into Australian dollars, you get about 1,875 Australian dollars. So when we look at the ultimate picture of what happened with our investment, we started with 1,000 Australian dollars and we grew it to $1,875, which means that you actually earned a return of 87.5% instead of that initial 100% in terms of US dollars. So as you can see from that example, the currency fluctuations between the Australian and US dollar caused your return to drop by 12.5%. So it was 100% in terms of US dollars, but when you converted it back, you lost 12.5% on the exchange and ended up only making 87.5%. So it's a reasonable question to ask if there is a way to deal with this in order to overcome some of these impacts. So then of course, let's talk about what I personally do in order to mitigate against some of these impacts. The short answer here is that I really don't do a lot. I will explain the small things that I do, and I'll explain why I do them. Changes in the demand and supply of currency is just something that I don't know how to predict, in the same way that I don't know how to predict the supply or the demand of gold or something like oil. But of course, we're not trading stocks in gold or oil, we're trading them with currency. So it is important to be able to mitigate them, and I do have a pretty simple strategy in order to deal with it. The first thing that I try to do is that I always hold significant amounts of currency in both US and Australian dollars. And essentially that does a couple of things. The first thing is that I'm never at the mercy of a bad exchange rate if I need to make a quick trade. So if a stock falls 20-30% and it's really attractive to me, if I had no US dollars, I would have to convert some Australian dollars at whatever rate is at the current rate. But if I have a little bit in US dollars and a little bit in Australian, then I'm not at the mercy of that exchange rate at the time. The second thing is that it also spreads out the risk of either currency failing, meaning that I have currency in both. So if the US dollar failed or the Australian dollar failed, I'd still have some cash available in the other currency, although I don't think that this is a likely possibility anytime soon, if at all. And the second thing is that I'm just happy to hold US currency if I sell some US stocks and the exchange rate isn't as attractive as it was when I bought them. So when I buy a stock in US dollars, I'll get a certain exchange rate. If sometime in the future I'm selling that stock and it turns out that I've made a 2 or 3 or 4% loss in terms of currency, I will just leave the money that I got from selling the stock in US dollars until the currency comes back to being a zero effect, and then I will convert it back into Australian dollars. Something else interesting to mention is that the official interest rate set by the central bank of your country, so for the US that's the Federal Reserve, and for Australia that's the Reserve Bank of Australia, the official rate that they set has a huge impact on the supply and demand for that currency. When the official interest rate goes up, the return that international investors can make on bonds in that country also goes up, and that increases the demand for a particular currency. And of course, with the increase of demand for a currency, the price and the strength of that currency will go up with it. And we've seen this happen in the US for the past 1.5 or 2 years. As the US Federal Reserve has been increasing interest rates, you've seen the strength of the US dollar go up. Now, this doesn't mean that if a country is raising interest rates that you should buy their currency because it means that it's going to get stronger. This is one factor, but there are many other factors, and currency is really, really unpredictable in the big picture. There's really no way that you're going to be able to predict what the supply and demand for a particular currency is going to be. I hope you guys enjoyed this one, and if you did and you want to learn more, make sure you become a subscriber, hit that subscribe button and hit that notification bell so you don't miss out on any of the videos coming out in the future. But I hope you guys have a great day, and I'll see you in the next one.